Hey guys, Mike here. So obviously, there's a lot of crypto news going around, people trying to figure out where this market is heading. And so, we're going to look at, the macro view. We'll go over the charts, see where Bitcoin is, where it's probably going to be going to, the altcoins, what they're doing. And then just look at, a lot of things that people are looking at right now. They're kind of hanging their hat on to say, this is telling us this is where crypto should go, because you see a lot of models out there that are having to be scrapped, right? Because how many people talked about 100,000 Bitcoin in November, and they shifted to December? And yes, could that still happen because crypto does move parabolically sometimes? Absolutely. But I think people are starting to see if it's going to happen, it's most likely going to be in 2022 now. And so we're just going to look at that stuff, kind of let you know where it stands. If you're like me, just kind of holding still right now, waiting to see where this goes. And so if you're getting out of it, please hit the like, subscribe button for me, guys. That's all I ask. And let's go ahead and get into the charts first. And so starting off with Bitcoin's chart, I told you I would update this obviously with the Fear and Greed Index. And you can see we've been on this nice downward trend here, and went from 84 down to 21, down to 27, or up to 27 actually, down to 16, up to 24, down to 16. And so, obviously on this trend line, just steadily kind of going down. And so we never did reclaim the 53,600, which everybody was hoping to reclaim. Obviously the next level is around 41,000 there, as you can see. And so one thing I want you to do is look at the 10-year Treasury yield. This is something you can also take a look at to see where Bitcoin and crypto is probably going, because they really go hand in hand. As the yield goes up, crypto goes up, because that means people are taking on riskier assets. When the yields go down, as you can see, Bitcoin goes down because people are risk off at that point in time. And so what's been happening lately, you see the yields actually going down. And you can see right here with the Fear and Greed Index went from 16. Yesterday it was 27 of fear. Today we actually went up to 28 because it had regained the 50,000 mark over the weekend, but then dropped this morning as soon as the Asian markets actually opened up. And we can see with Ethereum and all the altcoins, Litecoin is down 2%, Sand 6%, Atom 8 is down 10% in the last 5 days, Ethereum 11, Dots 12, Vets 13, and you can see Matic, which actually did a really big run up, is down 23%. And one major reason Matic is so volatile, guys, because if you look over here, the top 10 wallets hold almost 75% of it. And so it doesn't take but one or two of those wallets to start selling to move this crypto back down, which I think that's what you've seen. It's been a big move down for Matic or Polygon, whichever name you like to use there. And so now I want to take you through what everybody's hanging their hat on, what you're seeing on Twitter, YouTube, and they're basing this off, past behavior, because all we got to go on is past data, past cycles to try to forecast where Bitcoin and the other cryptos are actually heading. And the first one is the Bitcoin balance on exchanges. And you can see we haven't seen it this low since go all the way back to 2019. We actually have the data. And so it's kind of an inverse relationship right now, as you can see. As Bitcoin is loaded up on the exchanges, or those balance actually increase, Bitcoin prices drop. As the Bitcoin balances decrease, usually Bitcoin prices go up. And then looking at the hash rate, it just set an all-time new high. And again, these are correlated together. As the hash rate goes up, usually Bitcoin price goes up as well, and hash rate comes down, then Bitcoin prices drop normally. And then as I always like to look on Twitter here, you can see this right here, the BTC net flow, which is net transfer volume from and to exchanges. And so if you read to the right there, it's plain and simple. Coins transferred to and from exchanges result in a net move of 23.2K coins moving off exchanges yesterday. This has only happened 3 other times in the last 2 years. Each time led to a price rally shortly after. And if we just zoom in on this, I'll show you what he's talking about. And we look right here, you can see the first one's on the left here. As soon as it hits this line right here, you see the Bitcoin price take off, and you see a nice rally right there. You see the second, which is a huge drop down. And then what happens to the price? See a nice big rally up. And you see the next one right here, obviously that continues that move up right there. And then you can see to the right there where it's hitting that support level. And so that's why people are expecting a move up. It doesn't happen instantaneously, but usually shortly after. And then another one was the net unrealized profit and loss. And you can see right here, there's the little range they point out. And when it bounces off of it to head down, you can see BTC price actually goes down. And then when it actually bounces and goes up, you can see Bitcoin price follows right along with it. And you see to the far right over here, that's when you see it's happening again. So again, you take this in correlation with all the rest of them, and people expect a nice bounce up. And then the last one here is the cup and handle people are seeing when it comes to the crypto total market cap, excluding Bitcoin. And you can see there's the cup, there's the handle. And usually what happens is it'll go up, and then we retest the resistance line before you start to get a push up right there. And this is just a better visualization of the cup and handle pattern. As you can see right there, we haven't hit the resistance line yet. And again, none of this is guaranteed, guys. This is just data. People are using it there to try to create these forecast models, see where it's going, whether it is going to go up, whether it is going to go down, what happened in the past, when this happened. And that's really all you can do, right? And so, the other thing to look at is when to purchase, when to sell. So I think looking at the fear and greed index, you can see right here, normally a buy zone. Some people put it 0 to 20. I like 0 to 30. That's when people are usually purchasing. I get some people do 0 to 20. I like 0 to 30, just because off the chart I made earlier. It just seems if you're still in the fear mode or extreme fear, that's when people are purchasing. You see the big run-ups when it does start to run up out of this zone here. And then the sell zone, some people put it 80 to 100. As I'll show you from the chart, though, we've had some huge pullbacks at around 74. So just to be safe, for an exit strategy, for me at least, I would start taking profits as soon as we start getting above 70 at all. And only because in the chart I showed you, you had one of the biggest pullbacks when it was at 74. And so, why not take a little off the table and I'll take the whole thing. But just an idea, more of a visual to look at on that. So hopefully that helps you out a little bit. Let us know in the comments, how you plan your exit strategy or when you're actually buying, that kind of stuff. And we're always looking for new ideas and stuff. So it never hurts as a community to share with each other. And what I want to leave you with is, obviously we had the hearing last week in Washington for a lot of crypto CEOs and people who know what they're talking about when it comes to crypto. And there was just two exchanges I wanted to leave you with. And I don't know about you, I want to definitely get your feedback, what you thought. If you watched any of the hearing, it was extremely long. But I thought these two exchanges, especially with this one gentleman, he's obviously a very smart guy and astute when it comes to crypto and markets in general. And so I want to leave you with these two. Let me know what you think about them in the comments and anything else you got out of that hearing.
But my fear is that this regulatory state, it's going to crack down on an industry that the regulators, they really don't understand yet. And it's going to force the next generation of financial tech to be created outside of our country. Where do companies draw the line and say that enough is enough with this anti-innovation, quote, regulation by enforcement, and then just decide to take their industry elsewhere to another country? Where's the line?
Well, Mr. Budd, it's good to see you, and thank you for that question. What I would say is, in some aspects of the industry, the line is super clear. There are some products that are legal in other countries and are just not legal here. So I take some of the investment products we've talked about earlier today, for example, exchange-traded funds. One of the things that makes crypto risky is that consumers may not understand the difference between one token and another token. And so they may want to diversify, much as I own an S&P 500 mutual fund. We don't allow that in the United States. We do allow it in Canada. We allow it in Germany, Singapore, Portugal, and a number of other places. So if you're a developer of those products, there's no fuzzy line. It's super clear. You can't do that here. So you have to go abroad, okay? There are some other places.
Can you say why we can't do that here?
Sure. It's because the Securities and Exchange Commission has consistently refused to approve products that other G20 nations have approved.
So we're behind the curve?
Unquestionably.
Can you talk about some of the negative consequences that could happen if we take a heavy-handed approach to regulating this developing technology?
Well, I come back to Mr. Vargas's question a second ago, which I think is the right way to answer your question. Mr. Vargas asked the question of people have the potential to lose a lot of money. These things are volatile, they're risky. How do we protect them from those kinds of issues? There are two ways of answering that. One is to prevent as many people as possible from accessing this amazing technology. For example, the way the current legal regime works is certain kinds of assets can only be purchased by accredited investors, meaning rich people. So the only people who can get rich on this are people who are already rich. That'd be one way of protecting people from losing money, is to make sure that only the richest can access it. Another way of addressing it would be to make it safer the way that we made equities safer 40 years ago, right? We created mutual funds diversification, sector funds, and other things that make it easier for regular Americans from places like my hometown in Colorado to buy equities without having to be stock experts. Strangely, in the US, we've refused to do that so far. So we don't allow crypto mutual funds. We don't allow people to diversify the way that they do in Canada, Germany, Singapore, the United Arab Emirates, and a series of other regulated economies around the world. So I would argue the way to win is to bring more people into the system more safely, not to keep them out at their own peril.
Hit that link down there in the bottom, sign up for a BlockFi account to earn 9% on your Stablecoins, 9.5% on your Tether, and 4 to 5% on your other cryptocurrency, as well as earn the 1.5% back on Bitcoin for every purchase you make on that credit card, guys. I will see you later.